systemic risk has not been released. And that is what they're trying to prevent. They're trying to prevent a Lehman moment where Lehman Brothers blows up, and then the next morning you wake up and a money market fund has broken the buck. And the next morning when you wake up, there's a Landesbank that you've never even heard of in Germany that's blowing up. And that is kind of the uncontrollable nature of systemic risk that is so frightens central bankers. It's something they've created. But the fact that we have not seen systemic risk erupt, and we'll know it when we see it. Trust me, it's like dogs and cats falling from the sky. Systemic risk, you know it when you see it. Because again, it's an uncontrolled train wreck. That has not happened. But I look at the financial system as something that is so interconnected that you want to know where the small spark is going to come from. What you're talking about with derivatives book, that's the full unwind. That's Armageddon. That is the end game, period end for the financial system as we know it. And I'm not so sure that this is going to be that black swan.
Welcome back to Liberty and Finance. We have a returning guest, Danielle DiMartino Booth, a former Fed insider and author of the book Fed Up, an insider's take on why the Fed is bad for America, joins us following the Sprott conference. Danielle, thanks for joining us again this Thursday, August 20th, 2020.
Great to be here.
We wanted to get your latest updates on, with the amazing year that we're enduring as a country and as a world, what you see as the most concerning aspects of the challenges that we're facing economically and financially, and then specifically if you could zoom in on the actions that the Fed has been taking and is currently taking, and how effective or ineffective you think those actions are. So could you first give us your view of the macroeconomic and financial picture that we're facing?
So I think what's most problematic for the macroeconomic environment is the whole idea of permanent job destruction. We're seeing small businesses close across America. Much of the demand for these small businesses could take a generation to return. And it's very problematic for a country that was already moving towards kind of oligopoly, monopoly type of business structure where the bigger only get bigger, to have this kind of a shock to the small business community, the small business economy. So employment had already decreased from about 52% a few years ago to 47% pre-COVID in the small business. And I think that number is going to be lower and stay lower for a long time. But we have to remember that every week that we see initial jobless claims filed, that these are first-time filers. So the fact that we're seeing a run rate of 1 million people a week is pretty astronomical in the context of the 160 million or so in the workforce. So it's clear that monetary policy has failed on this count. It is technically one of the Fed's mandates is to maximize employment. I've never believed that the Fed should have that mandate.
Right.
But that's technically part of their job. And it is also always been my opinion that it is the onus is upon the fiscal authorities in times of massive economic disruption to help out the unemployed. And yet the fiscal authorities in Washington, D.C. have also failed the small business community. Mm-hmm. So, I find that the long-term, the permanent joblessness, the permanent unemployment is really what concerns me the most at this juncture, especially against a backdrop of stocks trading at all-time highs, and therefore, increasing social strife continuing to build under the surface.
Now, are you saying that the tension between like the haves and have-nots, because of the high rewards that are being handed out to the large corporations, the large shareholders, that sort of thing, versus the unemployed masses, is going to cause that tension?
I mean, we've loaded companies up with so much debt over the past decade or so that instead of seeing Chapter 11 restructurings, we're seeing companies go straight to liquidation. because there's just so much debt. There's nothing that can be done to salvage the value. And when you think of restructuring and typical Chapter 11, you think of retaining employees to a certain degree. When you hear liquidation, that means everybody's fired. So again, we're starting to pay a very big price for the leverage that's been built up over the past decade.
In terms of the impact to large versus small businesses, what do you see? I mean, people have observed that. The common person has observed that all the mom and pop shops were being told, you can't be open, you can't keep your business going, and yet the large box stores were considered essential. Do you have any insight into that policy decision or why that would have been considered that small businesses were not essential but large businesses were essential?
Well, I think part of it was just pure public health and what we didn't know because China didn't release data. So, and that's certainly not a phenomenon that is unique to the United States. I think a lot of countries' small business sectors have been damaged in an imbalanced way because of the fear factor that was so pervasive in the early days of the pandemic leaving China. Sure. And again, had we not had people on Twitter in the middle of the night looking at, from satellite imagery going, oh my gosh, the crematoriums in Wuhan are going 24/7. You can see it from the satellite at night. If we didn't have the same fear factor, I'm not so sure that we would have had the same magnitude of a shutdown. And by the same token, had the authorities at a federal level, as what was done in countries that didn't shut down to the same extent. If you'd said, fine, if you don't want to wear a mask, it's a $10,000 fine. There were some places in Germany where it was a 10,000 euro fine. If you wanted to keep mom and pop businesses open, then you needed to make it safe to do so. And, if you're in a gigantic Walmart or Target, you can require that there only be so many people in the store at a certain time such that you're conforming to social distancing strictures. You can't do that in a small restaurant. But had we had cohesiveness at the federal level and a coordinated response that said everybody's going to have to wear a mask so that everybody feels safe and mom and pop businesses can stay open, I think the economy would be in a different place right now.
So you're just saying that it was the physical largeness of the large businesses or the uniformity of their management structure that made it possible for them to say that they could conform to specific protocols, whereas the smaller businesses in their diversity would be more difficult to corral that way? Is that what you were going at?
We've seen case after case after case study of individuals in small enclosed places, whether it be in South Korea or on a cruise ship, for example. But when you get in an enclosed space, that's when COVID tends to be the most contagious. And so that certainly doesn't, again, help out a smaller retailer or a smaller restaurant.
I see. Okay. Following your logic on that part. We have several questions, and I guess I'll group them together. A lot of people are talking about the limits of the Fed's or any central bank's ability to just keep creating currency to try to solve the nature of the problem that we're facing. Lucien Blondil says, can the Fed print $250 trillion to save the system? And that's interesting, save the system versus save the economy or the people. But maybe want to address those separately. First of all, is there a limit to this ability of currency creation to be effective, if you can start there?
So I think that if Dr. Lacey Hunt did a very telling interview recently with Bloomberg, so I hope everybody is able to read it. But I think if Fed liabilities were actually allowed to be legal tender, I think that you could have in other words, if there was an explicit recognition by the Fed, by federal authorities, that there was no limit to money printing, I think then that would be problematic. But that is why Federal Reserve officials are always so careful in saying we're not monetizing the debt. We can only buy securities in the secondary market. We cannot buy directly at Treasury auctions. Because if you cross that line, and it may be, semantics to you and me, but that is, and by crossing that line, you're saying, what's 25? What's 50 trillion? Who cares? We can just run the debt up as much as we want. That's when you start to really monkey with your reserve currency status and put that at risk. And when your reserve currency status is placed at risk, so is your ability to borrow. And it's pretty much as simple as that. We're not there yet. The European banking system did not get rid of its bad debts. The Japanese have more debt than we do. They made QE great in the first place. So the lack of alternatives to the dollar as a reserve currency is as much of the cliche double-edged sword as could ever exist, because we're being corrupted by it and pushing our debt to higher levels than we otherwise would if we didn't have the ability to say, haha, we have the reserve currency status. Look, we can print more. Won't work forever.
Do you feel that it's being effective now? Do you think that the current actions of the Fed, including currency creation, are addressing the need, that they're going to be effective at pulling us out of preventing whatever crisis we would have been otherwise further in if they hadn't been doing that?
I would say the answer to that is absolutely yes. And there's no counter argument to what I just said, because systemic risk has not been released. And that is what they're trying to prevent. They're trying to prevent a Lehman moment where Lehman Brothers blows up, and then the next morning you wake up and a money market fund has broken the buck. And the next morning when you wake up, there's a Landesbank that you've never even heard of in Germany that's blowing up. And that is kind of the uncontrollable nature of systemic risk that is so frightened central bankers. It's something they've created. But the fact that we have not seen systemic risk erupt, and we'll know it when we see it. Trust me, it's like dogs and cats falling from the sky. Systemic risk, you know it when you see it, because again, it's an uncontrolled train wreck. That has not happened. So that's what lets Jay Powell go to sleep every night, is that he knows he's contained the beast.
So that's what was my next question is, do you believe we are heading into a banking crisis and or a fiat crisis? And if so, what kind of timeline do you see that on? Because you're the one who started us, maybe you were the first one actually, who talked to us almost a year ago talking about we're on the clock for a recession. that was are we or are we not going into a recession? Oh my gosh, that's no longer the topic. But let's ask you that. Are we, in your view, heading into a banking crisis and heading into a currency crisis?
We're not heading into a banking crisis in the way that we look back to 2008, 2009. The biggest U.S. banks are not as much as risk as they were back then. Small banks in America have a problem. They have extremely concentrated, weak loan books. They're exposed to all these small and medium-sized businesses that are going under. They have a lot of construction loans. They have commercial and industrial loans. They have commercial real estate loans. And that is going to be problematic. And it's also going to create an issue for kind of the fabric of the country, the rural areas that are already underbanked, in that you're going to see small banks go. And so anytime somebody tells you that the banking system is 10 times stronger today than it was going into 08, 09, understand that they're referring to the 25 largest banks in the country, not the rest of them.
So I've not heard that statement. I've heard just the opposite, in fact, and I wanted to get you to weigh in on it. That people saying that with all the rules changes and currency creation and derivatives exposure and bets that the banks have made since the 2009 global financial crisis, that they're much more exposed, that their derivative books are more imbalanced now than they were back then. Is that not your view?
Derivatives are something that didn't blow up last time, and I'm not so sure will blow up this time. I look at banks on a more micro level. I see Japanese banks' exposure to collateralized loan obligations as being pretty problematic. And again, but I am concerned about the small banks a lot.
Yeah, you made a very interesting comment because we've seen articles, so many in the last couple of weeks, talking about is this the death of the cities? Is New York City going to ever survive, or any of these? Because we've had these concentrated, as you mentioned, small stores or small venues are problematic when you're worrying about pandemic, that kind of thing. Well, so are very highly concentrated urban areas where there's no food production. There's really nowhere to go.
But that's a whole separate matter. And I would argue that a lot of the mortgages that are being underwritten as there's this massive exodus from urban centers into the suburbs and into the exurbs, I don't know that that's necessarily the bank on the corner making those mortgages. It might be Bank of America. It might be Wells Fargo. So what I'm speaking about are the regulations that were put in place after Dodd-Frank that required small banks to be compliant to these regulations that really should have only applied to the largest banking institutions in the country. And because small banks' cost structure went through the roof, the only thing they could do to offset the cost of having to bring in all these compliance officers was make really bad loans. And they did.
You know, it's interesting because that phenomenon of regulations that don't scale down well is not unique to the financial industry. We have a activist farmer, Joel Salatin from Polyface Farms, on often talking about how that affects small food producers as well, because the rules are almost written by the large players in the industry, whatever that industry might be, pharmaceutical and food, and now financial as well.
Yeah, lobbyists are evil people.
There's certainly a pitfall there that can happen. We have a question still related to the Fed's actions and their policy. H. Paul Fuchs asked, what do you think of the Fed printing trillions out of thin air and buying up the planet?
Well, I don't like it. I don't like the fact that Apple hit a $2 trillion market capitalization and the Fed printed money to buy Apple bonds. So, I'm not a fan. That's my short answer. I think that the Fed has gone too far. And the worst part about it is that they're preventing creative destruction is going to keep a lot of deadwood in the economy for longer than it needs to be otherwise, which is going to really tear at productivity and make it to where on the other side of this COVID crisis, you don't have the same capacity in the economy to bring new entrants in who, by the way, employ people. So the Fed keeping dead companies alive, I think, is going to be with us for a very long time.
Wanted to circle back with you. You've talked about the dollar, and before we leave the dollar, and then we want to get to sound money such as gold afterwards, but before we leave the dollar, here's a rather flatly stated question. Cheap Kennedy says, does the dollar really have any value? You mentioned earlier about the overplaying your privilege as a world reserve currency can lead you into a loss of confidence by your global partners in that, and the rejection of the currency. You said you don't think we're there yet. Are we past a point of no return in that regards?
I'm a big fourth turning fan, and I believe that we are subject to long cycles. And I think that the only hope for taking us off the path of which there's no return is for there to be a massive leadership change in the country. I really do believe that. I can sound radical with you. I won't get in trouble. But I think that the time has come for a huge shift in national leadership, or we will end up going that route. At some point, China could rise. Okay,
so if you saw the courage and the principles being brought forth by this new leadership that would make you jump off your chair and say, yes, that's what I was talking about, what are the main 3-4 things you'd be looking for from this emerging new leader?
I think that the new leader would actually understand what capitalism is and allow markets to function the way they should. Again, we mentioned something that nobody talks about anymore, the second employment mandate from 1977. That needs to go bye-bye. The Federal Reserve needs to be an arbiter of setting interest rates, but mainly allowing the free markets to set prices. And that somebody who would rein in that ability, a leader who would truly reform the education system so that no child is left behind in the real world, not just in one zip code in every city that's got the good school system. So somebody who was interested in closing the inequality divide and in making policy that wasn't just for big businesses, but all businesses, in bringing back the American dream of working your way from rags to riches because you can get the education that everybody else can get. Those are the kind of things that I would love to see in a true leader, just ripping all the bureaucracy down. Throw lobbyists the hell out of Washington, D.C. So, I mean, just read the Constitution. So it seems like everybody in Washington reads like they read and they're like, I, the people. It doesn't read that way. It's not I, the people. It's we, the people. And so I would just want somebody who understood the basic tenets of democracy and capitalism. That would be a great start.
Yeah, one of the things you mentioned about the deficiencies of the education system is by design for the last century, the education system has been teaching generation after generation to think about collectivism and not about the principles of our Constitution or about true financial principles of sound economics either. So right. I don't think there's any zip codes, no matter how wealthy they are, that are actually turning out the majority of graduates who are well versed in reason, logic, understanding of our constitutional background, and sound economics. So I'm not sure we need to spread that. I think we need to introduce that everywhere, not
financial literacy is pretty important. Yeah. If you don't have if you don't have a financially literate citizenry, then you're going to have people who are slaves to debt. And guess what? That's what kind of a country we are.
Well, and isn't that a conflict of interest on the part of those designing the system? If slaves to debt makes them dependent upon the hand that gives being above the hand that receives, isn't that, you mentioned the perverse nature of lobbyists, because that's sort of it's a conflict of interest there. Isn't this also a conflict of interest in that and empowered people that are more independent are just that, more independent? They're not so dependent upon their keepers in the positions of power.
Well, our founding fathers would like that too. They didn't think that government needed to be an overbearing, overreaching entity. They believed in the people. That's why they put we in their words. So,
we have a question about gold and what you see the role that it's playing currently, or what's changing. There certainly has been a change in the behavior of the gold markets over the past year, for example. It's interesting that started before anybody had any whispers about COVID or anything. This was last summer we started to see, and it was just about the time that the Fed had to start doing the bond repos overnight to inject liquidity. What are you seeing as changes in the gold system and precious metals and the role that they're playing, maybe both from the perspective of the banking industry, the central banks, that sort of thing, as well as the ordinary participants in the trading of precious metals?
Well, I mean, we've all seen the data, right? We know that countries have built up their gold stores in recent years. But I think that what's happened, again, starting with not QE, starting with the repo mess, it was my birthday, September the 17th, when the Fed had to come running to the rescue and say, it's not QE, but boy, we better get it out there quick. You're right, there has been a shift. But the acceleration of that movement is definitely opposed. I mean, when you have a sell side from a big bulge bracket investment firm talking about gold, you know something has gone wrong. Totally. Because that's a big no-no at sell side firms. You don't talk about precious metals. For heaven's sake, you keep your clients in the stock market. That's the job of sell side firms. But the whole don't fight the Fed thing has come full circle into the precious metals market. It's hysterical. Because you've got all these Robin Hoodies. They're like, oh, silver, cool, wonderful, I'll go do that. And so I actually don't like the fact that speculators have rushed into the precious metals, and I'll be happy when they're gone again, because I consider gold to be a long-term holding in my portfolio, and I would prefer that speculators not be in it.
Do you think that whether you call it speculators or whether you call it those who are participating in order to influence the price or whatever, is a new thing, or do you think that's been more or less a constant over the past decades in the metals markets?
It's a fad thing. I think that Wall Street is enamored, and then it falls out of love with precious metals. It goes in cycles, and then there are people who think of it as being a core holding, and I think that there are different types of personalities.
Sure enough, yeah, certainly. And we've had, like Rick Rule has talked about, in the way he characterizes that, as he often does, he kind of distills it down to just a couple words. He says the gold buyers are fear buyers and the silver buyers are greed buyers, because one's looking for action and the other one's looking for stability. What do you
I don't
believe?
know. I own both, so I must be schizophrenic.
or maybe there's elements of truth to both, that where people want to have growth as part of their investing, but they also want to have something that's going to be anti-correlated to the other types of volatility in the markets. Do you believe that metals serve a function? Why do you have that in your portfolio? Why do you see that as important?
Well, because I used to work at the Federal Reserve, so I've seen correlations across asset classes line up to the number one enough times in my life to know that the only thing that truly provides a hedge when the peanut butter hits the fan, as my mentor used to say, is gold.
Well, Danielle, I know we have a limited time today, and I appreciate you visiting us again. But before we let you go, I wanted to ask any takeaways that you have from the participation in the Sprott virtual conference. Anything that you learned, anything that that virtual venue offered that you hadn't experienced before? Any takeaways that you could share with people?
Well, it was interesting because the interview that I did on Sprott and the venue that it was in, Albert and I talked for a long time. What I like most about it is it's got an afterlife, and so it's continuing to trend. It wasn't a moment in time on stage that then went away. It's something that is now virtual and still here. So it's kind of awesome. And, I see it come across my Twitter feed or LinkedIn, or somebody will throw a comment out there. It's still alive and well. So I think that is a lesson for us to learn about the virtues of virtuality. So, in future years, I'm going to make sure that even if I'm on stage, that I'm taped so I can keep it alive.
Yeah, for those of you who weren't able to register in time before the Sprott conference, those who attended the conference still have access to all of the recorded materials for the rest of this calendar year. So It's exactly what you're describing, all of the keynote presentations, all of the panels, all the interviews, that sort of thing. So Danielle DiMartino Booth, who is founder of Quill Intelligence, as you can see on her background there, is joining us again this time on Liberty and Finance. Danielle, thanks for joining us.
Thank you. Take care.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.